Hello everyone and welcome to SMS Study Station. So today we are going to see about the second method of ARR, accounting rate of return. You have seen the first method, okay, and we have solved two questions also based on that. So today we are going to see this second method. If you remember that first method, then it will be very easy for you to understand the second method also. For ARR, here the formula is annual average net profit after depreciation and tax divided by average investment into 100. If you remember that one, so only this is the difference here. Rest all things are same in the formula. Means in the first method there was initial investment. Rest all things were same in numerator and then multiplied by 100. Everything was same. Only this is the difference. In the second method, it is average investment. There it was initial investment. So numerator value, that is annual average net profit after depreciation and tax, that we will calculate as same we were doing in the first method. That will be same. Only for average investment, here we have two formulas. First is average investment equals initial investment minus scrap value divided by 2. So initial investment, and if a scrap value is given, subtract it and then divide it by 2. And then second method is initial investment minus a scrap value divided by 2 plus a scrap value plus additional net working capital. So this second method we will use only when additional net working capital will be given. Otherwise we will use this method only. Okay. If initial investment and a scrap value is given, even though scrap value is not given, then also we will take initial investment divided by 2. Otherwise initial investment minus a scrap value divided by 2. Only if when additional net working capital is given, then only we have to use the second formula, only when this is given. Otherwise we'll use that first one, and rest all things will be same. So here average investment we need to find out. So we let's move towards the question. So here the question is this. I have taken that same question which we have done in that first method. So this same question we'll solve through that second method also. So here first we will write what all we need. For numerator we need annual average net profit after depreciation and tax. So here profit after depreciation is and tax is already given, only we need to find out average. So annual average net profit after depreciation and tax. So we need to find average here. That means add all the profits and then divided by how many years? 5 years are there. So first year 2 lakh, second year 3 lakh, then 5 lakh, then 5 lakh 20,000, and then 3 lakh 20,000. This is all we will add, and because 5 years profits, so divided by 5. So this will be equal to 3 lakh 68,000 is this. Now for denominator we need average investment, correct? Because we are doing the second method. So for average investment, first we have to check if any additional net working capital is given or not. So here additional net working capital is not given. So for average investment we have to use the formula, that is initial investment minus scrap value divided by 2. And initial investment is given as 25 lakh. Here they have given project cost investment of 25 lakhs. So project cost is 25 lakh, that is initial investment, and scrap value here in the last they have mentioned, means at the end of 5 years if we are selling this plant, then it is still giving us this 1,50,000. So that 1,50,000 we will subtract and then divide it by 2. Okay, so this when you will be doing, you will get 11,75,000. So what all we need? We got both the things. Now just calculate ARR. For ARR, numerator we need annual average net profit after depreciation and tax, that is 3,68,000. Okay, average we have calculated, and for denominator we need average investment 11,75,000. So this we will take and multiply it by 100. So how much percent we will get here? Okay, so just calculate this and you will be getting 31.5 32% as ARR. Okay, so this is the case. Very simple. Just average investment you need to calculate, and for average investment we have two formula, remember that. So let's do one more question based on this. First read the information given in the question properly. Here also you have to calculate ARR on average investment. Okay, one thing, we have two methods to calculate ARR. First method is initial investment method and second one is average investment method. So if they will ask you in the question that you have to calculate ARR on like here they have asked calculate ARR on average investment, so you have to calculate with that method. If they have not asked, you can go by any method, anyone is fine. Just see based on the information you can use any method. Okay, so here in this question what all information is given. Now see, original cost means this is original cost, initial investment, that is same, that is 2 lakh. Working life is 5 years. Working life of this asset is 5 years. Salvage value or scrap value both are same, so salvage value is 20,000 and additional working capital, this you remember, 6,000. Tax rate 50%. Okay, tax rate also given, and profit before depreciation and taxes given, 5 years profit. So here see one thing, here they have already told us that we need to calculate ARR on average investment. That means we have to, in denominator we need average investment. So let's calculate average investment first. Okay, so for average investment we had two methods, and I told you if additional net working capital is given then we will be using second method. That means the method is the formula is initial investment minus scrap value divided by 2, and then in this add scrap value and then add additional working capital. So here initial investment is 2 lakh, scrap value is salvage value is 20,000, and then divided by 2, and again add scrap, that is 20,000, and then additional net working capital is 6,000. So this all you solve, you will get average investment. So after solving this you will get 1,16,000 as average investment. Okay, I hope it is clear. So this you got as average investment. So our denominator we got. Now for numerator we need annual average net profit after depreciation and tax. Here see, here profit before depreciation and tax is given. Profit before depreciation and tax is given. So we don't need before profit, we need profit after depreciation and tax. Means here profits are given for 5 years but neither depreciation nor tax is deducted from it. So we have to deduct depreciation as well as tax from these profits. So first tax rate is already given, that is 50%. For depreciation is not given in the question, so we can easily find it out, no problem for that. So first let's find out the depreciation. So depreciation, if it is not given, then cost divided by life of asset. So cost of asset is 2 lakh, and one more thing, scrap value is also given, so that we have to subtract from it. 20,000 is the scrap value and divided by life of asset is 5 years. So like this we can calculate depreciation, that is 36,000 is the depreciation. So we got depreciation. Now only we need to do one thing, that is first we have to deduct depreciation. First we need to deduct depreciation from the profits, and after deducting it we need to deduct tax from it. Then we will get profit after depreciation and tax, and when we will get that profit after depreciation tax, we need to find out average. That's it, and then we will put it in the formula, we'll get answer. So first let's find out profit after depreciation and tax. So prepare a statement for calculating profit after depreciation and tax. So here I am creating a statement. Okay, so here year, and then profits are given, means what is given in the question. So these profits are in 1000, 50,000, 45,000, like this they have given. So first we'll note down these profits. So first year it is 50,000, then 45,000, then 80,000, then 90,000, and then 75,000. So like this profits are given. Now we have to deduct depreciation from profit. So from these profits we have to deduct depreciation. So after deducting depreciation we will get profit before tax. Now this profits, now it is profit before depreciation and tax, so we have to deduct depreciation, and after deducting depreciation we will be getting profit before tax. Depreciation is 36,000, this we have to deduct from each year's profits. 50,000 minus 36,000, so 14,000. 45 minus 36, 9,000. 80 minus 36, 44,000. 90 minus 36, 54,000, and 75 minus 36 will be 39,000. Now depreciation is deducted, now we need to deduct tax. So this is profit after tax column we need to create. So from this PBT we need to deduct tax rate is 50%, so we need to deduct tax 50%. On 14,000, 50% is 7,000, so 14 minus 7, that will be 7,000. 9,000, it is 4,500, tax is 4,500, that will be deducted, so we will get that same 4,500. 49, okay, it is 44,000, here we will deduct tax, just 50% tax, calculate it and deduct from this PBT, so you will be getting this. Okay, and this last one is 19,500. So we got this. Okay, so that is fine. Fine. So we will take this total profit after depreciation and tax. So it is 80,000. Why we have taken this total? Because we need to find out average. So average, when we will find out, so average profit, net profit will be this 80,000 divided by 5 years are there, so 5, so we will be getting 16,000. So this 16,000 is annual average net profit after depreciation and tax. First we have calculated profit after depreciation and tax, means profits were given, so we have deducted tax, then we have first we will deduct depreciation, then we will deduct tax. So after deducting it we will get profit after depreciation and tax, and then we have found out average. So total profit for 5 years was 80,000, divided by 5 we got 16,000. Now ARR is simple, just in the numerator it is annual average net profit after depreciation and tax 16,000, and divided by average investment is this, earlier we have calculated 1,16,000 multiplied by 100, so it will be, how much you will get here, 13.79%. So I hope the second method is also clear to you. So now ARR method is completed. Just remember these two methods. First one is where you have to use initial investment. Okay, and second one is where you have to use average investment. Numerator will be same. Just read the statements. Sometimes they will give statements to confuse you. So just read the statements. Means what they have given, profit after depreciation and tax, profit before depreciation and tax, or maybe depreciation is deducted but tax is not deducted. So just identify that portion. Okay, this we have seen in that payback period also. So okay, so next video we will see next method. Thank you.